Welcome, everyone. Today, we are embarking on a comprehensive journey into organizational design and hierarchy, specifically focusing on how modern corporate treasury departments are structured for maximum efficiency, control, and strategic impact. Let's get started. Welcome to our first module. When we talk about organizational design and hierarchy within a corporate setting, especially in corporate treasury, we are talking about the very nervous system of the company's financial operations. What is it? It's the deliberate structuring of teams and reporting lines to manage liquidity, mitigate risk, and secure funding. At the foundational level, the treasurer typically reports directly to the CFO, sitting parallel to the financial controller. Why do we need a strict design? Because handling billions in global transactions requires an ironclad framework to ensure the right currency is in the right place at the exact right time. How we do this is by establishing a board-approved treasury policy that clearly delegates responsibilities. In our deep dive today, you'll see that treasury is no longer just a back-office execution hub. It is a strategic advisor to the business, guiding major decisions like mergers and acquisitions and global expansion. Take a look at the diagram on your screen. This flowchart maps out the classic, high-level reporting hierarchy of a corporate finance organization. At the top, you have the board of directors overseeing the CEO. The CEO then relies heavily on the Chief Financial Officer, or CFO. Notice how the hierarchy branches out under the CFO. The corporate treasurer and the financial controller occupy distinct, parallel branches. The controller typically handles accounting, accounts payable, and accounts receivable, focusing heavily on historical data and balance sheet accuracy. Meanwhile, the treasurer manages forward-looking liquidity, risk, and the actual teams executing financial operations. This structural separation is vital for maintaining checks and balances across the organization's cash flows. Moving on to slide 2, let's explore the golden rule of organizational design in finance, the segregation of duties. What does this mean? It means dividing the treasury into front, middle, and back offices. The basic premise is that no single person should ever have end-to-end control over a transaction. Why is this so critical? Because treasury deals with massive monetary values. Without this hierarchy, organizations are highly vulnerable to fraud, unauthorized trading, and devastating operational errors. How we structure this is straightforward. The front office negotiates and executes the deals, acting as the firm's face to the markets. The back office confirms, settles, and accounts for those deals. For our deep dive, let's highlight the middle office. This team is entirely independent from the dealers. They oversee risk limits, validate valuation models, and perform independent reconciliations, serving as the ultimate control mechanism. Let's walk through this process diagram to see how a transaction flows safely through an organization. On the left, we have the front office, which interacts directly with the external financial markets to execute a trade. Once the deal is struck, the details flow immediately to the middle office. Notice the dotted line pointing upward from the middle office directly to the CFO or risk head. This represents their independent reporting line. They ensure the front office hasn't breached any risk limits. Finally, the approved data passes to the back office on the right. This team handles the actual movement of cash, settlements, and posting the final entries into the company's general ledger. By strictly enforcing these boundaries, the hierarchy naturally protects the firm's assets. Now that we understand team roles, let's look at global hierarchy. Slide 3 covers decentralized versus centralized organizations. What is this? It's the strategic choice of whether local subsidiaries handle their own money, or if a global headquarters controls it all. The basics are simple. Decentralized means independent local action, while centralized means pooled cash and coordinated global strategies. Why choose one over the other? Decentralized teams are highly agile and possess intimate knowledge of local banking customs. However, centralization is the modern gold standard because it slashes costs, maximizes cash visibility, and tightens corporate control. How do companies centralize? By implementing global treasury management systems that connect all subsidiaries. In our deep dive, it's clear that decentralized models lead to wasted money like borrowing at high rates in one country while cash sits idle in another. Since the 2008 financial crisis, the shift toward centralization has been massive to ensure corporate survival. This visual comparison starkly highlights the difference between the two structural models. On the left, in the decentralized block, you see local entity A dealing strictly with local bank A, completely isolated from local entity B. There is no synergy. Now, look at the centralized block on the right. Here, the Global Treasury HQ sits at the absolute top of the hierarchy. It acts as the central brain. It pushes and pulls funds from Entity A and Entity B as needed, and it negotiates master agreements with a global bank. This structural design allows the company to offset the debts of one subsidiary with the surplus of another, bypassing the banks entirely and saving millions in interest and spread costs. Slide 4 maps out the structural evolution of a growing company, moving from shared service centers, or SSCs, to dedicated treasury centers. What are they? They are specialized hubs designed to centralize tasks for maximum efficiency. The key basics to remember: an SSC is built for high-volume, low-complexity work. A treasury center handles high-complexity, low-volume work. Why divide them? Because you want to separate routine administrative data entry from high-stakes financial strategy. How does this look in practice? The SSC takes over global accounts payable, receivables, and payroll. The Treasury Center steps in to execute multi-million-dollar FX trades, negotiate bank debt, and concentrate cash. Deep diving into this, setting up an SSC drastically cuts headcount costs and standardizes processing. Adding a Treasury Center elevates the organization, empowering the treasurer to optimize the firm's capital structure and enforce unified risk management across the globe. Let's follow the evolutionary timeline depicted in this flowchart. We start on the far left with decentralized local teams, which is often chaotic and expensive. The first major evolutionary step is to standardize operations by funneling them into a shared service center. Once the routine processing is stable, the hierarchy evolves to establish a basic treasury center, shifting focus to cash positioning and FX. Finally, on the far right, we reach the ultimate maturity stage, the value-added treasury center. At this level of the hierarchy, the Treasury is fully empowered to engage in strategic liquidity sourcing, intercompany funding, and sophisticated risk modeling for the entire global enterprise. We now arrive at Slide 5, the pinnacle of Treasury organizational design, the in-house bank, or IHB. What is an IHB? It is an advanced setup where the central Treasury literally acts as the bank for all internal corporate subsidiaries. The basics are fascinating. Subsidiaries stop using external banks for their daily intercompany transactions. Instead, they hold internal accounts with the IHB. Why go through this effort? Because it entirely eliminates the bid/offer spreads and fees paid to external banks, minimizes the need for outside borrowing, and consolidates all currency risk into one place. How it works is that the IHB performs group-wide netting, funds subsidiaries directly, and is the only entity that trades with Wall Street. For our deep dive, we look at reinvoicing. An IHB can buy goods from a manufacturing sub and sell to a sales sub, absorbing all currency risks so the local teams only ever deal in their home currency. It is a masterful structural advantage. This diagram elegantly illustrates the hub-and-spoke power of the in-house bank model. In the center, the IHB stands as the ultimate financial authority. Radiating outward, subsidiaries A, B, and C interact only with the IHB. They maintain internal balances, borrowing from or lending to the IHB rather than going to local banks. Because all internal flows are netted against each other, the net residual risk is drastically minimized. Look at the bottom of the diagram. The IHB acts as the single, powerful point of contact with external global banks and financial markets. This consolidates the company's negotiating power and ensures that external capital is raised at the absolute lowest cost possible. As organizations grow into massive multinationals, a single HQ isn't enough. Slide 6 explores regional treasury centers, or RTCs. What are they? They are localized hubs like one for Asia, one for Europe, and one for the Americas that report to a global HQ, but manage their specific time zones. The basics form a hybrid model. You maintain global strategic control, but execute regionally. Why do this? Because global commerce never sleeps. RTCs eliminate time zone delays, bridge cultural and language gaps, and handle complex local regulations. How it functions: Global HQ writes the policy. The RTC executes the daily cash sweeps and local bank relationships. Deep diving into RTC placement, companies choose locations like Singapore or London based on tax incentives, robust banking tech, and access to skilled talent. Furthermore, an RTC is crucial for navigating restrictive emerging markets with heavy capital controls, which a distant HQ simply couldn't manage effectively. Look at the geographic hierarchy displayed here. At the very top, Global Treasury HQ dictates the overarching risk appetite and policy. But the execution power is distributed to the three major pillars: the Americas RDC, the EMEA RDC, and the APAC RDC. This ensures that when the Asian markets open, the Singapore RTC is fully awake and empowered to manage the liquidity of the Japan and China subsidiaries without waiting 12 hours for the global HQ to come online. This structural design perfectly balances the need for tight, centralized governance with the absolute necessity of local market agility and regulatory compliance. On slide 7, we bridge the gap between organizational design and technology. We are looking at systems integration and hierarchical entitlements. What does this mean? It means your treasury management system must perfectly mirror your physical organizational chart. The basics dictate that digital permissions must enforce the segregation of duties we discussed earlier. Why? Because a policy on paper is useless if your software allows a single user to both execute and settle a trade. How do we build this? By using role-based access controls when configuring the system. Let's look at the sample code on the slide. This JSON snippet defines a user in the APAC region. Their role is front office dealer, so their permissions only include execute FX, capped at a 5 million limit. Most importantly, it digitally binds them to report to the head of RTC APAC. By coding the hierarchy directly into the system, the software physically prevents this dealer from accessing back-office settlement screens, thereby cementing your organizational design into an unbreakable digital reality. This diagram illustrates the concept of maker-checker controls hard-coded into Treasury architecture. The corporate hierarchy on the left acts as the blueprint for the TMS access controls. The workflow strictly forces a front office maker to input a trade. The system then automatically routes it to the middle office checker to verify limits. Finally, it moves to the back office settler to release the funds. Look at the dotted line at the bottom marked system block. This is the technological enforcement of your organizational design. Even if the front office user wanted to release the funds, the system architecture physically prevents them from crossing that hierarchical boundary. For our final slide, let's tie everything together with a real-time use case. Imagine a company, global growing group, operating in over 50 countries. Their organizational design was completely decentralized. Local teams operated in silos, leading to bloated costs, trapped cash, and zero visibility for the CFO. How did they fix this? They executed a transformation roadmap. First, they standardized global policies. Next, they deployed a unified treasury management system. Then, they drastically reduced their bank accounts and shifted to an in-house bank model supported by regional centers. The results were staggering. By restructuring the hierarchy, they achieved a 50% reduction in banking fees, streamlined headcount, and finally gave the CFO total control over global risk. Ultimately, organizational design in Treasury isn't just about drawing org charts. It is a strategic weapon used to lower the cost of capital and drive enterprise value. Thank you for joining this deep dive. I invite you to like, subscribe, and visit quicktechie.com for premium certification prep, including Q&A banks, full ebooks, audiobooks, full-length training, and interview guides. This final roadmap visualizes the transformation journey of a corporate treasury. You begin on the left, trapped in decentralized chaos characterized by high costs and unmanaged risk. The journey to excellence starts with Phase 1, standardizing policies and implementing a robust treasury management system. This paves the way for Phase 2, the structural leap, where you build out regional treasury centers and an in-house bank. Finally, you arrive at the optimized state on the right. Your new organizational hierarchy has successfully minimized external borrowing, slashed operational costs, and maximized enterprise value, proving that optimal design is the key to financial leadership.